Glyn. We saw a marked change in the trends driving markets during April. Can you provide an overview of the main themes that you saw?
Yes, there was a distinct change. We saw perhaps the biggest consensus trade for the last several months has been the dollar going up. We had a big setback in the dollar in April, fell 4 or 5% against the euro in particular, which of course had been very weak. We saw a very sudden and steep reversal in bond markets, especially in Europe, and in fact that really led the world. And remember, European bond yields had gone to all-time lows, so they moved up very quickly from about the middle of the month onwards. And in fact, investing in German government bonds in mid-April, you'd have lost 5% of your money by now. So safe haven investments, when they are extremely overvalued, can be dangerous, as we've been saying for some time. We saw a big reversal in some of the commodity markets, a big rally in oil. Again, the consensus view had been that oil was going to stay low for a long time. Well, up 20% in April, so that wasn't quite the case. So quite a distinct change in trend in some very big and important markets in the month. And the factors underlying that, I think, are quite instructive in many ways. We saw, well, first of all, I think valuations really matter. At some stage, when assets become so overvalued, you're going to get a setback. And I think that to some degree is what happened in Eurozone government bonds. And in fact, today, Eurozone government bond yields are back at levels where they were at when the ECB introduced its QE program. So it's quite an interesting shift there. The other thing that's happened is that this slowdown in growth that we've been referring to in the US, this growth pause, was evident through the month, with quite a series of sort of data that came in weaker than expected in the US, and then the first quarter GDP numbers came in much lower than people expected, 0.2% quarter-on-quarter growth. So raised sort of concerns about whether the US was actually going through a bit more than a growth pause. And in fact, underlying those growth numbers in the US in the first quarter, there was a big build-up of inventories, so it's pretty likely that the second quarter is going to be fairly slow as well. So that was a bit of a worry and a factor behind the weak dollar in the month, because of course the strong dollar has had a negative impact on growth in the US and on the trade figures, exports and so on. So there were some pretty big factors in sort of worrying people here. In contrast, the Eurozone, albeit from a very low base of growth, has shown better numbers and is looking towards better growth in the course of the next 12 months. So we are now seeing some I guess corrections of what we've seen in the past few months, with very strong dollar reversing, very weak commodity markets in some cases reversing, and I think it's sort of a reminder that markets don't always go trending in one direction forever. There are going to be setbacks from time to time.
Yep. And the strong dollar was fairly broad-based across a range of other currencies.
It was very broad-based. Sterling was strong, perhaps a surprise to a lot of people ahead of the general election, which happens to be tomorrow, with what is evidently, according to the polls, a very uncertain outcome. You would think that sterling actually would have been quite weak. In fact, it was strong. It almost kept pace with a very strong euro, which was up about 5% in the month. A lot of emerging market currencies had a good rally in the course of the month. The yen was pretty stable, but it's been stable all year, in fact. It was a pretty broad-based fall in the dollar, and in fact the trade-weighted dollar index was down 3 or 4%. It was a big move.
Yeah. And in terms of big moves, the emerging market assets surged during the month.
Yeah, look, that was the other big trend. That for some time now, really for several years, we've seen developed equity markets consistently performing better than emerging markets. This month we had a reversal of that in a big way. So in April, the emerging market index globally was up nearly 8%, whereas the MSCI World was up just over 2%. It's taken emerging markets this year up 10%, well ahead of developed markets. So we had a big shift in emerging markets. Quite a number of emerging markets doing very well. Brazil recovering from weakness. Russia doing very well. Russia's up nearly 40% so far this year in dollar terms, incidentally. Obviously helped by the oil price rally. But I think that perhaps the most notable one was China. China has had a big move this year now. It's up 18% or so in April alone, and it's taken it up to 37% so far this year, having been relatively weak for quite a long period of time. So I think that was a pretty significant factor in the course of the month, driving emerging markets generally higher, as well, of course, as the fall in the dollar. That helps emerging markets, and the trending, or the reversal of trend in weak commodity markets. So pick up in commodity markets definitely helps emerging markets.
Okay, and what was the end result in terms of asset class returns?
Well, we saw equities doing better than bonds, with this big reversal in bond yields going up. And to put it in perspective, German yields on the 10-year bond at the very lowest point in mid-April were 7 basis points. I mean, 7 basis points is literally nothing. Today they're about 58 basis points, and that's all in the space of 2 or 3 weeks. That's a very big move. That has led to bond yields everywhere going up. So the US 10-year is back at 2%. We saw bonds performing relatively poorly, and in fact most government bond markets in the developed world were down in the month. The global bond index was up a little bit, but that's because of the currency impact of the dollar weakness, whereas as I've mentioned earlier, equity markets were generally pretty strong, up 2 or 3% in the developed world, 7 or 8% in the emerging world. Interestingly, in the fixed income area, high-grade corporate bonds performed pretty much in line with government bonds, down, but high-yield bonds performed actually really rather well, so it was produced a good return, and convertible bonds had another very good month, which has clearly helped our portfolios, because we've got significant exposure there.
Yeah. Okay. And you mentioned the large oil price move, in terms
Yes.
of the percentage gains.
Yes.
Was dramatic during the month.
It was dramatic. It was just over 20% move in Brent crude in the month, and in fact, from the March lows, the oil price is now up by nearly 50%. Now, part of that, I think, was just a sort of natural reaction to this dramatic collapse that we'd seen in the oil price in the previous 6 or 9 months. But part is due to the simple fact that growth of production is clearly slowing down. In the US, we've seen huge cuts in capital spending on shale production, and we're beginning to see the impact already of slowing production, and that's having an impact globally. You've also got this pretty unstable situation in the Middle East. This Saudi intervention in Yemen is definitely unsettling for people. One moment they're pulling out, the next they're back in again. It raises this whole spectre of a broader conflict, sectarian conflict across the region. So although Yemen itself is not a big producer of oil, if Saudi Arabia gets involved in some way, that's pretty bad news. So there's been a couple of sort of fundamental factors together with the technical factor that was oversold. But I think realistically, it's pretty unlikely we're going to see the oil price back at below $50 a barrel now in this cycle.
Okay. And where does this leave us in terms of your outlook?
Well, I think what we've seen this month is a pretty useful reminder, as I said earlier, that markets don't just trend relentlessly in one direction, and certainly valuation really matters. We've said for some time that government bond yields, safe haven government bond yields, are ridiculously expensive. They have backed off quite a lot, but they remain very expensive, probably underpinned by this QE program in Europe and Japan. I think the other important thing to remember is that this growth pause we're seeing in the US, we do think it's a growth pause. We think there were certain sort of seasonal factors, and the oil price weakness which hit certain states, in particular in the US, are likely to be sort of short-term and temporary, but nevertheless growth is going to be modest, relatively slow, and I think the Fed is going to be slow to move on rates. So we're still looking ahead to fairly low rates for a long period of time. The ECB and the Bank of Japan remaining intent on their big QE programs, so pumping huge amounts of liquidity and underpinning markets. So we're going to get these setbacks from time to time, but I think ultimately equity markets are pretty well underpinned by that liquidity and by this sort of pickup in growth we're seeing outside the US, albeit modestly, but nevertheless it's an encouraging sign. So broadly positive, but watch out for these big moves, and certainly watch out for what's happening in China, because a lot of the activity in China has been speculative activity, leveraged, and there were some useful reminders that China's still got some problems. We had the first couple of serious defaults by Chinese corporates in the month, so that's something to watch out for. And the ongoing problem with Greece, of course, in Europe is something to watch out for. It's an ongoing saga, and it probably will be resolved with Greece staying in the euro, but nevertheless it's something that we are mindful of in the weeks ahead.
Indeed. Okay, Glyn, thank you very much.